Today topic real estate transactions impact in Income Tax Act. May I request our chairman Sri Roy Varghese to welcome our speaker and all the participants.
Respected senior members, colleagues and friends in profession. Very respected T.Banusekhar sir, my colleagues in Managing Committee of Ernakulam branch of ICAI, good afternoon to you all. Today is the third day of the 5-day virtual change seminar on direct tax organized by Ernakulam branch of ICAI. We are discussing today one of the hot topics, real estate transactions, impact in Income Tax Act. Real estate transactions are considered as one of the main sources for generation and application of black money. The government is regularly trying to plug loopholes in such transactions by inserting various provisions from time to time in the Income Tax. And for this, number of amendments have been introduced in the Income Tax Act in recent years. The most important amendments in this regard are Section 56(2), Subclause 7, Section 50C, and Section 43CA, which covers more or less all types of transactions related to transfer of immovable property. Further, Section 194 1A for deduction of tax at source in case of sale of immovable property was also introduced. Demonetization was also a one-step intended to weed out the large-scale black money menace in real estate transactions. However, demonetization and the consequent economic downfall brought the real estate sector to the brink of collapse and in a standstill position. To support the sector, government has introduced various fiscal measures and policy reforms also. Despite the reforms by Government of India to incentivize the sector, the ever-changing tax and regulatory landscape in India makes real estate transactions and its taxation quite complex. Today, we have with us a very learned resource person, T.Banusekhar sir, to discuss with us on this very important topic and the impact of real estate transactions in T.Banusekhar sir had already prepared and sent us the background material for the discussion today, and an SMS was sent to each and every one of the registered participants and is asking them to download it from the website and use it for tax, and a highly sought after speaker, and we are really fortunate to have him with us as a resource person today. On behalf of Ernakulam branch of ICAI, I extend a warm welcome to the resource person T.Banusekhar sir to this session. I welcome all the colleagues and seniors and friends in profession and the managing committee members present here, KV Joe Secretary, the Ranjit Vair Vice Chairman, the Salim Study Circle Coordinator, and all other managing committee members to this seminar. Hope you will have a wonderful learning time today. As usual again, if you want to raise any question, you can raise it in the Q&A box. Don't mix your comments with the questions in the chat box. So always put your questions in the Q&A box, not in the chat box. And CPE credits, you must register and attend the seminar, and the attendance report is being generated from the web platform, and it is the proof of your attendance. So please ensure that you attend the seminar throughout and take every opportunity in this discussion. Once again, I wish you all have a wonderful learning time. Stay safe and healthy. Thank you so much.
Thank you, Chairman Sri Roy Varghese. May I request our SICASA Chairman, Sri Alan Joseph, to introduce our speaker for this afternoon.
Thank you, sir. Members of Ernakulam branch don't really need an introduction to CA T.Banusekhar. However, it's my absolute pleasure to introduce our speaker and partner of Messrs. CRBS and Associates in Chennai. Bhanusekhar sir is one of the leading direct tax professionals in the country. He has argued various high-profile and landmark decisions before the appellate tribunal on various contemporary issues, thereby helping set precedents in our own cases. Some of the most famous cases include a case on Ford India Limited's case on deduction of warranty expenses and South India Corporation Limited's case on disallowance of interest paid on borrowed funds on account of interest-free advances to group concerns. Bhanusekhar sir has also frequently appears before the Settlement Commission, and sir has authored 2 books. One is on the handbook on assessment procedures under the Income Tax Act, and the second book is on search assessment under the Income Tax Act. Throughout his career, Bhanusekhar sir has served the institute in various capacities, and including presenting papers across the country and serving as a member of the SIRC. Presently, he is a co-opted member of the Direct Tax and International Tax Committee of the SIRC of ICAI. We are all eagerly looking forward to your session, sir, and we want you to commence your session. Thank you.
Thank you, Alan Joseph. Thank you for the kind words. And thank you, Chairman, for the introduction to the subject. I will first give a brief of how I propose to proceed with the whole program. What I have done is I have identified some issues, not some, many issues, in fact, including on 45(5)(a), which was a section actually inserted to ensure that there is no litigation, but can probably generate more litigation than all other sections combined because of the various interpretational issues that arise as a result of the way the section is worded. I have identified these issues and I have circulated it. I have already discussed with your chairman, or rather our chairman, because Ernakulam happens to be virtually a home branch for me. I should call him our chairman, not your chairman. So, including me, I think he is our chairman. So, I have circulated it to him. And probably that may help us to have a meaningful discussion. During the course of the session, friends, it will be my endeavor to try and deal with each and every one of these issues and probably also the case laws on the subject. Well, I will also try and share all the case laws that I am discussing with the chairman immediately after the session so that it will avoid the trouble of having to make notes of the citations. And Chairman, sir, you can have that circulated to all the registered parties. Friends, you can feel free any time to raise questions in the Q&A box so that, I will be able to try and answer it as and when required. Or I will take it towards the end depending on the nature of the question. And the chairman has requested that we should have a break at around 4:30 for 10 minutes, which also we will ensure we have so that we are able to, listen or, go through the 3-hour session a more comfortable. Well, friends, I will start with issue number 1. Issue number 1 is a very simple case where an assessee owned a property measuring 15,200 square feet, which he purchased sometime in September 1980. The cost of acquisition being 20 lakhs, and he has entered into a joint development agreement. He has entered into a joint development agreement in January 2017. In June 2017, he has executed a power of attorney in favor of the developer, and thereafter in 2020, the developer has demolished the existing building and he is constructing a fresh building at measuring 22,400 square feet. And 3 of the flats, which are aggregating to 7,200 square feet in all, plus a monetary consideration is to be paid to the landowner. And the developer's share, he has sold some part of it starting from March 17 to April 2020. Now friends, before I proceed, I have also taken into account certain situations which are exceptional in nature, which probably can arise as a result of the pandemic as well. Because I think many builders have literally abandoned the buildings in the present scenario. They are not able to proceed with the construction, and most of them have even given up in the sense that at least in Chennai they have given up and they are no longer in a position to proceed with the building at all. Those are also situations that I have mentioned. Now, as far as this is concerned, the first issue that I have raised is, this is a registered JDA. What happens or when does the capital gain arise? That is a very straightforward question because 45(5)(a) says that the capital gain will arise. The capital gain will arise in the year in which the completion certificate is issued. The completion certificate is issued or at the time when the landowner's share in the building is transferred, whichever is earlier. Completion certificate is issued or in the year in which the landowner transfers his share in the superstructure. Now there are number of unanswered questions here. If I must put it very simply, I will take these issues straight away. You may have to address it over and over again. But then the issues that can arise are, supposing I am doing a large structure as a developer, then I obtain the completion certificate block-wise. Supposing I am doing 6 blocks, then I may obtain the completion certificate for block 1, block 2, block 3, block 4 independent. So which is the year in which the completion certificate is issued becomes a question. The next is they say that the year in which the sellers or the landowner sells his share. Please note that the landowner can sell his share of the structure only post the completion of the structure. So the selling of the structure can never happen before the issuance of the completion certificate logically. So are they referring to his right to get the building constructed which is being transferred? This is the second question that needs to be answered. There are many issues like this, but then for the time being, we will rest our case here by saying that it will be in the year in which the completion certificate is received or in the year in which the landowner sells his share in the property, whichever is earlier. Second, what if there is a monetary consideration, but the monetary consideration is not received when the completion certificate is received? In any case, the capital gain cannot be deferred under 45(5)(a) beyond the date on which the monetary consideration, the completion certificate is received. This will be the second aspect. Third, what will be the sale consideration? Now here, the lawmaker seems to have said that the stamp duty value of the landowner's share, which he is getting in the superstructure, the stamp duty value of the share that the landowner is getting in the superstructure should be taken as a full value of consideration for the landowner. I would personally, for one, not agree with this, but the law is so. We cannot help it. I would have thought the cost of construction of the builder should be the full value of consideration of the landowner. That should be the logic, but unfortunately, logic and law need not always go together. Further, you will see that the next question is with regard to the manner in which 45(5)(a) will be invocable. You will see that 45(5)(a) was inserted with effect from 1/4/2018. And in the instant case, you will see that the agreement is dated sometime in January 2017. The joint development agreement. I am presuming the joint development agreement is registered because my understanding is that in Kerala it has to be registered. If it is an unregistered joint development agreement, 45(5)(a) has no operation because a specified agreement for the purpose of 45(5)(a) means only a registered agreement. If there is no registered agreement, then 45(5)(a) has no operation. So if we presume that this is a registered document or an agreement, then the next question, will 45(5)(a) apply at all in the present circumstance? Why this question arises is because 45(5)(a) was inserted in effect from 1/4/2018, whereas this joint development agreement is dated January 2007. So, effectively, if we say 45(5)(a) is applicable to this transaction, then we are saying that the provisions of 45(5)(a) are retrospective in operation. We are saying the provisions of 45(5)(a) are retrospective in operation. While that is said, we can also look at the decision of the Supreme Court in Allied Motors, which was rendered in the context of 43B. He reported in 224 ITR 677, and also the decision in Calcutta Export Company in the Supreme Court rendered in the context of 43B in 404 ITR 6. where they held that the provisions are retrospective. Interestingly, we have a decision of the Hyderabad bench of the tribunal, which is reported in 4 Tax Management India 37, 2018, 4 Tax Management India 37, where the Hyderabad tribunal has held that the provisions of 45(5)(a) are not retrospective in operation because they create a charge. Now, before we proceed, friends, we have to understand that 45(5)(a) was basically inserted to avoid a hardship on when the capital gain is taxable, because there was a mismatch between the flow of revenue in the case of a joint development agreement vis-a-vis the taxability in the case of a joint development agreement. Therefore, 45(5)(a) was inserted, so there can be one theory that 45(5)(a) was inserted to avoid a genuine hardship which was created to assessees, in which case one can easily conclude that the provisions of 45(5)(a) are retrospective in operation. But then if somebody looks at this as a provision creating a charge, then this may not be an appropriate view. Now, at this juncture, we have to look into whether 45(5)(a) is optional or mandatory. One can, in my view, canvass a theory that 45(5)(a) is not mandatory in operation, but is optional. So, an assessee wishes to offer capital gains tax even at the time when the joint development agreement is entered into, on the premise that possession has been handed over to the developer. If I am willing to offer the capital gains tax in the year in which I enter into the joint development agreement, on the premise that that possession has been handed over, nothing can stop me from offering the capital gains to tax. The reason being that once possession is handed over, by virtue of 247, a transfer is said to have happened. Incidentally, you will notice that though 45(5)(a) has been inserted, there has been no amendment in 247. Therefore, I can offer the capital gains tax in the year in which I hand over possession, and thus the capital gain can be offered in that year also. So to that extent, I will say that 45(5)(a) is optional in nature. But of course, it will depend on the facts of the case. When I say it is optional in nature, it does not mean that the assessing officer or the SC can choose whatever he wants. Based on the facts of the case, one will have to decide the operation of 45(5)(a). So to that extent, I will agree with the Hyderabad tribunal, the Hyderabad bench of the tribunal, where it has held that 45(5)(a) creates a substantive taxability in a particular year and therefore cannot be applied retrospectively, except where the assessee himself chooses to be bound by 45(5)(a) by not handing over possession at an earlier point in time. Proceeding further, you will see that, as I said, 45(5)(a) does not refer to the postponement of the transfer. And as I said, 247, the definition of the term transfer, has also not been amended. 247 has not been amended. So what will happen is that the transfer will be said to have taken place in the year. Transfer will be said to have taken place in the regular year in which the joint development agreement is entered into. Only that the charge, the taxability or the charge is postponed to another year. So friends, you will understand that the next question that will arise is with regard to indexation benefit. With regard to indexation benefit, friends, you will recollect that the provisions relating to indexation in section 48 make it very clear that indexation is to be done up to the date of or the financial year of transfer. So, if there is a transfer in the current year, but your charge is getting postponed to the next year, then friends, in my view, the provisions relating to indexation will apply only up to the current year and not up to the next year when the charge arises. Charge will happen in a different year, indexation will be up to a particular year. Now 45(5)(a) has been inserted, but I have, without application of 45(5)(a), offered the tax even in the assessment year 17-18. What is the recourse available to me? I can still file a revised return if applicable, or move a 264 petition and offer the capital gains in the year in which the completion certificate is received, or as the case may be, when as a landowner I transfer my share in the property. Right? So that is still possible. And the remedy may lie in filing an appropriate revised return or moving a 264 petition for revision before the Commissioner of Income Tax. The next issue which I have discussed is what would be the position if the landowner sells 2 out of the 3 flats allotted to him before obtaining the completion certificate. Now, why does this question become relevant? This question becomes relevant because the law is very clear in saying that or providing that the capital gains will be charged in the year in which the completion certificate is received, or when the landowner transfers his share in the property, Now, once we accept this proposition, the difficulty that can arise is, in the instant case, we are referring to a scenario where the landowner has transferred only part of his share in the property. Now, if one were to look at 45(5)(a), if one were to look at the language in 45(5)(a), it reads like this. It says that, I am reading from the provision, just bear with me for a moment. It says, notwithstanding anything contained in subsection 1, where the capital gain rises to an assessee being an individual or issuer, from the transfer of a capital asset being land or building or both under a specified agreement, capital gains shall be chargeable to income tax as the income of the previous year in which the certificate for completion for whole or part of the project is issued. So, if we go back, you will recollect one of the issues I had raised was, supposing I have multiple blocks. If I obtain a completion certificate for only one block, what happens? The language used is for the whole or part of the project is issued by the competent authority. And for the purpose of 48, the stamp duty value as on the date of issue of certificate of his share being land and building or both in the project, as increased by the consideration received in cash, if any, shall be deemed to be the full value of consideration received or accrued, provided that the provisions of this subsection shall not apply where the assessee transfers his share in the project on or before the date of issue of the said certificate of completion, and the capital gain shall be deemed to be the income of the previous year in which such transfer takes place. Now, they have not talked about the landowner selling the whole or a part of his project or part of his share in the project. It says shall not apply where the assessee transfers his share. Unlike in the case of completion certificate, where the provisions of 45(5)(a) start off with saying that it will be in respect of whole or part of the project in respect of receipt of completion certificate, corresponding provision is not found here. Therefore, it might be an arguable case. It will be an arguable case, and the assessee can say that the capital gains that has arisen is only pro rata. So, in the instant case, 7,200 relates to 3 flats. The assessee is only selling 2 of them. So, at that point, the capital gain should arise only in respect of 2 of the flats. And balance should arise at a later point. That is when the other flat is sold or when the completion certificate is received, whichever is earlier. Now, this creates a lot of difficulty. There, in my opinion, can be a lot of litigation on this because ultimately it is an outside chance that any assessee will sell the whole of his share in the property. He may retain at least 1 or 2 flats for his own personal use and the use of his immediate family, like his sons, his daughters, etc. Right? The next issue. Now, you are now liable for a GST. You are liable for a GST which is payable on the flats allotted to you. What happens to a GST? In my view, the GST cannot be treated as a cost of improvement, etc. It will only be taken as the cost of acquisition of the 3 new flats. It should be taken as the cost of acquisition of the 3 new flats. Incidentally, you will notice that even there can be a slight bit of a difficulty. The department is likely to take a different view of the matter because Section 49 of the Act has been amended to provide that whatever is taken as the full value of consideration here for the purpose of 45(5)(a) will automatically become the cost of acquisition. That is the stamp duty value of, in the instant case, 7,200 square feet of built-up area. So that stamp duty value, which is taken as a consideration for the landowner at the point in time when the completion certificate is issued, would automatically, by virtue of 49, become the cost of acquisition when he proposes to sell these 3 flats. Unfortunately, 49 does not look at GST in respect of these 3 flats. But in my view, common sense should say that GST which the landowner paid should automatically be taken as the cost. 49 does not debar me from taking anything else, but only provides that in the event of there being an invocation of 45(5)(a), there should not be any difficulty caused to assessee, and whatever is deemed as a full value of consideration by virtue of 45(5)(a) should automatically be taken as a cost for the purpose of determining capital gain when these 3 flats are sold. Next, the property was originally acquired in 1980 and you are offering the capital gains in, say, the financial year 16-17, relevant to 17-18, then logically you can substitute the fair market values of 1481 to be the full value of consideration. You can substitute the fair market values of 1481 to be the full value of consideration. But if you are offering it later, starting from 1/4/2018, then you can substitute the fair market value as of 1/4/2001 because there is an amendment. You can substitute the fair market values of 1/4/2001 as the full value of consideration. Next, the flats are sold between 2017-18 and 2021. Can he take the fair market values of 2001? Yes. For whatever is after 1/4/18, he can definitely take the fair market values of 1/4. Are there any tedious obligations on the developer under 194IA? 194IA deals with a situation where there is a transfer of certain assets. If you will see section 194IA, 194IA obviously deals with a scenario where any person being a transferee responsible for paying to a resident transferor by way of consideration for transfer of immovable property shall at the time of. That is what is provided for. Now 194IA in my view will have no application in the case of a joint development agreement. That reason why I would say that is prima facie one can see 194IA does not at all talk or cover a JDA situation. But if one were to see 194IC, Then it says, notwithstanding anything contained in 194 IA, any person responsible, please see that 194 IC overrides 194 IA because it starts the non-obstante clause. Any person responsible for paying to a resident any sum by way of consideration, not being consideration in kind, shall at the time of, and says that the TDS shall be 10%. So 194 IC will apply in respect of the monetary consideration under 194 IC. Tax has to be deducted at source. Tax has to be deducted at source under 194 IC. No, 194 IA is not triggered at all in the case of a joint development agreement. 194 IA does not get triggered at all in the case of a joint development agreement. What gets triggered is 194 IC and not 194 IA. Okay? And this is only in respect to the monetary consideration. Next, supposing the landowner has transferred land along with building to the developer, can he claim the cost of construction of the demolished building also as cost of acquisition for the purpose of computing capital? It depends on the terms of the JDA. If the JDA mentions that you are transferring land and building, the demolition being done by the developer, though the approval may be taken by the landowner, the demolition being done by the developer, then probably one can say the cost of the existing superstructure that is demolished can also be taken as cost for the purpose of computing capital. Now, this may also decide whether you are permitted to make your claim under 54 or 54F. If you are transferring a residential house, you get 54. If you are transferring only the land, then you get the benefit, if at all, of 54F only. Next is what will happen if the developer has become insolvent, because in Chennai we are now facing, particularly as a result of the the downtrend in the real estate, and after the demonetization, many builders have abandoned the buildings. They have completed it halfway through and left it as such. Likewise, we also have, after the pandemic, many builders saying we are not in a position to continue with the construction. So, in which case, if the landowner incurs some additional expenditure to identify a new developer, or he himself incurs the expenditure, can that also be taken as expenditure incurred for the purpose of computing the capital gain? The answer should be yes. And merely that by itself should not make it a situation where the SSE should be said or would be said to have entered into an adventure in the nature of trade, and it should not make him chargeable to tax under the head. It should not make him chargeable to tax under the head profits and gains of business or profession, because he is not entering into a business venture. He entered into a joint development agreement, but unfortunately, the developer has become bankrupt, and therefore I as a landowner, I'm forced to complete the construction. That should not work against me to say that I have entered into an adventure in the nature of trade. This is so far as the first issue is. Now this has a wide gamut of the provisions of 45. I will have some more issues on 45.5a. I will proceed with issue number 2. Now, in the same set of facts that are given in the first issue, can Thomas claim, that is the landowner claim, 54F in respect to the flats allotted to him? Now, you will see that he is being allotted 3 flats. He is being allotted 3 flats. Now, if you see the conditions in 54F, of course, there is no doubt after the amendment that the SSE is entitled to claim the expense, the deduction or exemption under 54F only in respect of one of the flats. There, the amendment has made it clear there is no longer that debate. So, out of the 3 flats itself, can I claim it for one of the flats? Now, why does this question arise? If you see 54F, one of the conditions is you should not be the owner of any residential house, barring one residential house other than the new asset on the date of transfer. So on the date of transfer, other than new asset, you can be owner of only one other asset. 2. Within 1 year from the date on which you are transferring, you should not acquire any other residence. So there are both conditions. So what happens in such case? Now I am being allotted 3 flats. I am being allotted 3 flats. Interestingly, there is a very nice decision of the Madras High Court, couple of decisions. One reported in 394 ITR 666, 394 ITR 666, the Madras High Court, and also the Madras High Court reported in 373 ITR 127. In both these cases, they say that since these flats are being allotted simultaneously, there cannot be a case for denial of 54F. 54F is available. Of course, friends, I will quickly say that it is applicable only for one of the flats post the amendment. That issue is no longer an issue in dispute because the law has been amended. Next, Thomas has handed over the land and building to the developer. Is he entitled to 54? Again, that will depend on the facts. As I said earlier, if he has only transferred the land and he has taken up the demolition of the superstructure, then he is entitled to only 54F. But if he has transferred the land along with the residential house, he is entitled to 54 itself. Next, if yes, by what time should the construction be completed so as to entitle the SSE to be eligible for 54F? Now, this is a big problem. Please note that the date on which or the year in which you are charged to tax has been extended. The date on which you are charged to tax has been extended, but the date on which you are transferring the property continues to remain the same. Now, in this background, when should you say that you should invest? Logically, the law says purchase 1 year before or construct within 2 years from the date of transfer for the purpose of exemption, or construct within 3 years, purchase 1 year before or 2 years after, or construct within a period of 3 years. Now, when does the 3-year period start? Is it from the date on which the completion certificate is issued? Please note that the date of completion certificate is only the date of charge. The date of transfer still remains the date of the agreement, probably in most cases. So what happens in such circumstances? Unfortunately, the law has not been made clear in this regard, but one can rely on 2 circulars. One is circular number 560. Circular number 560, dated 1/4/1992, rendered in the context of 54E, and the other is a circular which was issued in 2000, circular number 791 of 2000, where in the context of 54EA, EB and EC, and in case of conversion of capital asset into stock and trade, it was held. In all these cases, the circular had stated that the year in which the consideration is received, that is, the stock and trade is sold, will be the time for will determine the time for making the investment. So that can be argued, but I would have been happier if the law had been made clear. Unfortunately, the law is not clear, and this may be only an arguable position. I will repeat. In the context of conversion of capital asset into stock and trade, for the purpose of 54E, we have circular number 560, of 1990, 560 of 1990, and in the context of 54 EA, EB, and EC, circular number 791 of 2000. Circular number 791 of 2000. Can I just take a minute? It appears that. So, this is another aspect that you have to bear in mind. This is the other confusion which I was referring to. Now, the next issue is, for the purpose of claiming exemption, how can the cost of investment in a new property be computed? Because what is happening is, I am giving away a part of my land as a landowner to the developer, and the developer is giving me a built-up area. The developer is giving me a built-up area. What should be taken as the consideration is one aspect, because as far as consideration is concerned, the provisions of 54 EA are very, very clear. 45 5A are very clear. It says the stamp duty value as on the date of issue of certificate of his share, being land and building or both. In fact, one would wonder why they have used the word his share in land and building, because what I am transferring as a landowner is only land, and what I am getting is only building. So it should be my share in the building. I do not know why the word land is used at all, because I don't get from the builder land at all. I get from the builder only building. Land already belongs to me. I am not transferring my share in the land to anybody. I am transferring a part of my land to you as a developer, and you as a developer are giving me a built-up area. That's all. So what I am getting is only a built-up area. But then for the purpose of exemption, under 54 or 54F, etc., the issue that arises is, what is the amount that I should take as investment? Please note, for determining consideration, it is a stamp duty value. But for the purpose of 54 or 54F exemption, in my view, the amount invested, whether it can be taken as the stamp duty value of the said superstructure, will be highly debatable. It may be highly debatable. One, the department is likely to take a view that it is only the amount that the builder expended to construct this building that will be taken as the amount of investment. So there is a mismatch again. There will be a mismatch again between the capital gain that is being computed on the basis of stamp duty value vis-a-vis the capital gain that is computed based on 45 5A, that is the stamp duty value, vis-a-vis the amount of reinvestment made for the purpose of exemption. This can be a debatable issue again, and I think that the lawmakers can make this clear. But logically, whatever you are taking as the amount that I am receiving as consideration should be the amount that is reinvested, because I am getting nothing, assuming there is no monetary consideration in the past. I am getting nothing other than this. So whatever I have got, I have reinvested. Whatever I have got, I have reinvested. So logically, it should be the same, but that can be still a debatable issue, and problems can arise here also. Next, I am going to issue number 3. If in the same example, that is example under issue 1, instead of a joint development agreement and a power of attorney, what if I give it on a works fund? That is the simplest thing to do. Then 45 5A has no application at all. 45 5A has no application at all, because it is not a joint development agreement, and therefore there can be no dispute or difficulty in coming to the conclusion that the provisions of 45 5A is not applicable. When we say 45 5A is not applicable, the other question which may arise is, can one say that the landowner has now entered into an adventure in the nature of trade? I would think so, yes. If I am going to engage a person as a contractor, build a superstructure and sell it, then logically I have entered into an adventure in the nature of trade. And if I have entered into an adventure in the nature of trade, then income may get charged under the head profits and gains of business as a profession. And even for that reason, 45(5)(a) will not apply, because 45(5)(a) can apply only if the income is chargeable under the head capital gains and not otherwise. Of course, we may have to look into various other aspects like the income computation disclosure standards 3 for construction contracts and ICDS 4 for revenue recognition. ICDS 4 for revenue recognition once you say it is a business activity. You will also have to look into the application of 45(2), which I will be dealing with elaborately a little later, and therefore I am not taking it at this point. Now, in the same example, let's assume the landowner grants a registered power of attorney in 2016, but no activity is taken up for the developer for more than 3 years. How would the taxability be? Again, 45(5)(a), whether it will apply to the facts of the case, because the JDA is entered into sometime in 2016. As I discussed earlier, the Hyderabad bench of the tribunal says 45(5)(a) creates a substantive liability and therefore is not retrospective in operation. I may not be fully in agreement with that view, but it is restricted to the facts of the case. I will not agree with that as a complete legal proposition. I would say that 45(5)(a) may have no application if the assessee says possession has been handed over even at the date on which the JDA is entered. So if you say so, then the capital gain may arise even in the year in which the registered agreement is entered into, because if it is not registered, then we also have the decision of Supreme Court in a case called Balbir Singh Maini, which is reported in 398 ITR 531. 398 ITR 531, where they say if it is not a registered agreement, then there can be no transfer, for which they have relied on the amendment made in section 17 of the Registration Act, read with 53A of the transfer. Read with 53A of the transfer. So that is one other area which you may just remember for the time being. So as far as issue number 4 is concerned, there cannot be any capital gains that will arise now, because no substantial activity has taken place. In fact, you may also see the decision of the Hyderabad tribunal reported in 64 SOT, reported in 64 SOT 86, 64 SOT 86, and also the Hyderabad tribunal in 149 ITR Trib, 149 ITR 169. These are two decisions that you may look into. I'm sorry, it should be 149 ITD, not ITR. 160. The next issue. An assessee holds certain agricultural land which he has converted into residential use for residential purposes. He appoints a developer to develop the lands into residential plots. He is not developing the houses, he is developing it into residential plots. All permissions have been obtained by the assessee, that is Yusuf by name. Marketing for the plots is done by himself, that is the assessee Yusuf. In consideration for the development, the Yusuf does not have money, so he is giving some of the plots as consideration for the development into residential plots to the developer. Will 45(5)(a) apply? 45(5)(a) will not apply, because 45(5)(a) is only for joint development. And this is not a joint development agreement. This is only conversion of land into plots. 45(5)(a) will not be applicable. Okay? There will not be the application of 45(5)(a). Of course, I would still think that the charge will arise under the head capital gains and should not arise under the head profits and gains of business. Because department sometimes is taking a view that since the development into residential plots has been done by the assessee, it should be taken as business or profit. See, every landowner wants to extract the maximum value for the land when he wants to sell it. Now, if he feels that by plotting it as residential plots, he will get a better amount, he will do so. There is nothing wrong. That by itself does not make it an adventurous nature of trade. And in my view, it will still be chargeable under the head capital gains and not under the head profits and gains. In the same example, if the revenue sharing is done based on sale consideration, I am not going to allot plots to you, sir. I am going to enter into some kind of a revenue sharing agreement with the developer. Now, what will happen in such cases? In my view, the department can consider this as an association of persons comprised of the landowner and the developer and seek to tax it in the hands of the AOP. Okay. Next issue. Would 45(5)(a) be applicable? Would 45(5)(a) be applicable even in cases where the seller obtains the immovable property by one of the modes given in 49(1) and there is a pre-existing agreement for joint development of the property? Now this becomes very important because if you see 45(5)(a), it says where the capital gain arises to an assessee being an individual HF from transfer of capital asset being land or building or both under a specified agreement. And specified agreement means a registered agreement in which a person owning land or building or both agrees to allow another person to develop a real estate project on such land or building or both in consideration of a share being land or building or both with or without payment of part of the consideration in cash. Now, the trick lies here. If you read the language very carefully, whenever an individual enters into a specified agreement, an individual or HUF enters into a specified agreement, 45(5)(a) can get begun. Now, 45(5)(a) in its explanation, clause 2 says, means a registered agreement in which a person owning land or building or both. But in the facts of our present case, what has happened? A has entered into the joint development agreement. A dies and there is a pre-existing agreement entered into by A with a developer. Now the legal heirs have substituted the A. So as far as the legal heirs are concerned, they have got the property by one of the modes specified in 49(1). So the property has devolved on the legal heirs. Now can one say 45(5)(a) has no application? I would think so not. I would think so that 45(5)(a) still has application. It is not necessary that I must have entered into the agreement for 45(5)(a) to apply. 45(5)(a) says in which a person. So A entered into an agreement, say he is a person. Now the fact that he died and legal heirs, the fact that he died and legal heirs came to substitute him in the agreement, because normally every agreement will say or is assigned. Or is assigned. So logically the agreement will now also devolve on the legal heirs and consequently the legal heirs may have to pay the tax under 45. But then the difficulty arises here. Please see that 247 is not amended. The charge is postponed. The transfer has already happened. So what happens in the instant case? The transfer has been made by A in our example, but the charge has been postponed to a different year because he died during the currency of the agreement before the completion. Sir. He died during the currency of the agreement, but before the issue of completion certificate. Therefore, now the charge will arise in the hands of the legal heir. the charge would arise in the hands of the legal heirs, but the transfer has already happened. Right? The transfer has already happened. Therefore, 45(5)(a) will still have application, but the person in respect of whom the capital gains arises is the deceased in the example. Of course, by virtue of 159, this tax liability, section 159, this liability has to be borne by the legal heirs. No doubt there. But the charge arises on whom? One can say that the charge arises on the deceased in the example that we are taking. The next issue, part of the same question, would it make a difference if the same developer continues the transaction though with some modification? Now, if there is a modification to the terms of agreement, there would be no difference and still the legal heirs will be bound in the same manner as we discussed in the earlier example itself. In the same manner as we discussed in the earlier example itself. I'll go on to issue number 8. Issue number 8. A private limited owns certain extent of land, and intends to part with this land, which is developed into a residential complex comprising of villas, twin houses, row houses, 4 in one cluster in certain residential areas, and commercial spaces, and such other developments and amenities as agreed between A Private Limited and the developer B Private Limited, who is in the business of property development. Now, before reading further, the first aspect that we have to notice is that here 45(5)(a) has no application. 45(5)(a) has application only if the transferor, that is the landowner, is an individual or HUF. Only when the landowner is an individual or HUF. Where the landowner is not an individual or HUF, which in the present case, you will see that the landowner is a company, automatically it will mean that 45(5)(a) has no application. I continue. A Private Limited and B Private Limited come together by executing a JDA for development of the property belonging to A Private Limited, whereby A Private Limited will offer the land and will be entitled to 27.5% of the revenue. B Private Limited, who will undertake the activities connected to development, will be entitled to 72.5% of the revenue. The shares are subject to minor changes in the event of a change in the or some variation in the or delays in the agreement. Now, in this case, the question is the applicability of 45(2) first. The question is first on the applicability of 45(2). So we are now presuming that A Private Limited held the asset as stock in trade. As a capital asset. A Private Limited held the asset as a capital asset and converted it into stock in trade. Right? And converted it into stock in trade. Now, basically, you have this old decision of the Supreme Court in a case called Bai Shireen Bai Puka. Where the Supreme Court held that on conversion of capital asset into stock and trade, no capital gain arises. Consequently, there was amendments made in section 247 and in section 45 to provide that conversion of capital asset into stock and trade can also come within the ambit of transfer. Okay. So, if A Private Limited held this as a capital asset and converted it into stock and trade, then 45(2) is invocable. Now, in which year is the income to be charged to tax? Will be the next question. Now, if you look at the provisions of 45(2), first of all, you will see that it very clearly provides that the charge will be in the year in which the stock in trade is sold or otherwise transferred. the stock in trade is sold or otherwise transferred. So, when there is a conversion of the capital asset into stock and trade, when there is the conversion of capital asset into stock and trade, there will be no charge though the transfer has taken place. This is similar to your 45(5)(a). Transfer has taken place, but capital gain will arise later. Right? This is similar to that. So, one will see that the capital gain is chargeable in the year in which the stock and trade is sold or otherwise transferred. Now, this becomes very important. The language used is in the year in which it is sold or otherwise transferred. If one were to read carefully. So, supposing you envisage a situation where the sale does not take place, but the stock and trade is otherwise transferred by some way. That is, say, for example, there is a partnership firm, the partnership firm is dissolved, and one of the partners take over the asset being stock and trade. Then one can always say that the stock and trade has been otherwise transferred, and therefore the capital gains will become capital. Okay. So, one, you will find that 45(2) is similar to 45(5)(a) by deferring the charge alone without deferring the year of transferability. Without deferring the year of transferability. So, indexation will be available only up to the date on which the capital asset is converted into stock. Only up to that date, indexation will be available. Beyond that date, the benefit of indexation will not be available. But for the purpose of reinvestment, if you will go by the circulars issued by the board in the context of 54E, EA, EB and EC, that is circulars number 560 of 1990, 560 of 1990 and circular number 791 of 2000. 791 of 2000. You can say that for reinvestment, the date on which the capital gain is chargeable should be taken. But again, I will warn you that this circular has been issued. This circular has been issued, unfortunately, only in the context of 54E, EA, EB and EC and has not been issued in the context of 54 of 54F. So it may again lead to some litigation. Of course, I am quite convinced that the appellate authorities will probably give you the relief based on this circular and taking a more pragmatic view. But I am not sure whether you are likely to get this at the stage of assessment. Now, friends, at this stage, you will recall that our chairman was also referring to the faceless assessment that's going to happen. I am not sure. I am very happy that we don't have to go to the income tax department, sit down, wait, etc. But I'm not sure how successful the faceless assessment will be. Because I'm afraid that sometimes, we need to explain in detail, personally probably, for an officer to be able to understand the nuances of various aspects. It may not be possible for us to explain it only over an email. Of course, they are saying we will give you a virtual opportunity if necessary, etc. But even that, in my view, may not be sufficient. Because honestly to say, we have been having some virtual hearings. We have been having some virtual hearings before the dispute resolution panel. We have had some virtual hearings before the tribunal. And I must say there is a lot to be desired. In fact, even our technology sometimes does not support it fully. Even our technology does not support it fully. In fact, if I can share with you, it is much more stressful to talk on a virtual platform than to talk personally when I come and meet all of you in person at Erna. There's a huge difference even there. It is not the same to my mind. It is not the same to my mind. But anyway, coming back to the issue in hand, this could be a highly litigious area but then I would believe that ultimately the benefit of doubt should go to the SSC, and I'm sure appellate authorities may find favor with the argument that we are taking. The argument that we are taking. The next issue in the same thing is, what would be the extent of charge under the various heads? So, the law provides that the fair market value as on the date of conversion, the fair market value as on the date of conversion will be taken as the full value of consideration. The fair market value as on the date of conversion should be taken as the full value. Now, for the purpose of determining fair market value, what should be taken? Can we take the guideline value? Is the next issue. Or what you call the stamp duty value. In my view, fair market value is a defined term which says the amount that the property will fetch if sold in the open market. That, in my view, is different from the term stamp duty valuation. So fair market value need not be the same as stamp duty value, but then the SSC may have a substantial burden to show how he is determining the fair market value, assuming he is not taking the stamp duty valuation. Next, in the same issue, what if there is a reverse situation where stock in trade is converted into a capital asset? Now, interestingly, we have an amendment in 28(6)(a).